Hi guys, welcome back. Today we're going to be looking at Alibaba. As you can see, and as you might have seen tracking the market, the stock has had a horrible year. Over the last year, the stock is down close to 60 percent, dropping down from a high of $309, currently trading at 125. So it's seen significant percentages of its growth wear away over the last year. It's trading at a PE ratio of just over 17, which is extremely cheap, especially for the growth that it promises. However, and I just want to make this clear, that is not the whole story. So today we're going to be looking at 5 things that you should know if you want to invest in Alibaba. We'll be looking at one bear case and one bull case for this company, because I have seen a lot of hype trains all over YouTube, and I've seen a lot of them discussing either Alibaba has nothing to deliver over the next 10 years, this company is something of the past, there's no hope, or I've seen the complete opposite, where I've seen this company is a massive value stock, this company is something that's going to be the next Amazon, something like that, and it's going to deliver 10 times, 20 times growth over the next decade. So today I'm try to find a middle ground in between these two sides, and try to give a holistic view on Alibaba as a company. And if you do find this useful and you do find this video informative, do consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. Onto the video. So the first thing we're going to be looking at is just some news that came out of Alibaba a few days ago. So this is on ZDNet and it reads that Alibaba restructures to split global local e-commerce businesses. So Alibaba Group has unveiled a major restructuring plan that will see the Chinese internet giant split its global and domestic e-commerce businesses into two separate units. Citing the need for agility, it also announces several leadership appointments, including a new CFO who will assume his new role in April next year. Alibaba said it would focus on its investment on the two strategic pillars to better drive synergies across its consumer and wholesale commerce performance in China as well as internationally, and its chairman, CEO Daniel Zhang, said in a letter to employees that the company's international digital commerce unit will pull together its overseas e-commerce and wholesale businesses, including Lazada, Alibaba.com, and AliExpress. Alibaba's recent quarterly earnings put its international annual active consumers at about 285 million, while its domestic annual active customers Blake clocked in at about 953 million, and its total figure tipped at 1.24 billion, which was a net growth of 62 million over the previous quarter and 20% increase year over year. The Chinese company is targeting to hit 1 billion annual active consumers in China by mid 2022 and 2 billion globally in the longer term, and they haven't really specified a date for this. Zhang said that this is the CEO. Zhang said that they will continue to focus on becoming a truly globalized company, and we believe that overseas markets present many exciting potential and opportunities for them to capture. We have confidence in our local teams, and we are charting a path forward with a holistic strategic blueprint and organizational stability for winning our overseas market. The company's latest quarterly earnings saw its overseas revenue grow 33%, with its Southeast Asian e-commerce platform Lazada clocking 82% order growth year on year and triple digital growth in Malaysia, Thailand, and Vietnam as well. Their domestic commerce business would be parked under its new China Digital Commerce Unit, which it said would better drive collaboration. And the domestic business unit would be hemmed by one of the founding members and partner, Trudy Day, who had previously served as the chief customer office and has led various businesses, including Taobao Deals and Alibaba's community marketplace, Tao Tai Tai. Alibaba's new international business would be headed by Jiang Fan, who has been with the company since 2013. Previously, was the president of its domestic consumer marketplaces, Taobao and Tmall. And prior to joining Alibaba, he also helped founded mobile analytics company Umeng. And this is just some extra information. If you want to pause and read the rest of it, you're more than welcome to. So the first thing we're going to be looking at is 3 different articles. We're going to be looking at one from the Dividend Sensei, which is a neutral article, which is the 5 things that you should know. Then we're going to be looking at Alibaba looks like dead money, which is a very bearish article. And we'll also be looking at the other one we're looking at is Alibaba benefiting from increased consumption and the digital transformation, which is by Eric Sprague, and that is a more of a bullish article. So the first one is the bullish article on Alibaba. So a summary of this article is that China's middle class population is growing rapidly and is almost the same size as the entirety of the US population, and the shift to digital will be accelerated by 5G and Internet of Things devices, and given a longer term outlook, the stock looks cheap right now. So the thesis by Eric Sprague is that Alibaba will continue benefiting from an increased consumption and the digital transformation in China. This will take years, and it doesn't mean every quarter will be better than the last. The September quarter was disappointing, but he remains optimistic for the future. There are multiple risks with many Chinese stocks at this time, and Alibaba in particular. Many investors have sold Alibaba because of the risks, and the price has gone down substantially. The anti-monopoly fine of US 2.7 2,700 million hit on the March 2021 quarter, and while he is optimistic that we won't see more penalties like this on a regular basis, there is continued risk in this area. Another concern is China's common prosperity approach to inequality. Alibaba issued a release in September saying that they will invest 100 billion by 2025 to promote common prosperity, and an October Reuters article reports that the economic growth in China has slowed down, citing the National Bureau of Statistics, which says quarterly GDP expansion slowed from 7.9% year over year in the June quarter to 4.9% year over year in the September quarter. On December the 2nd, Didi announced that they are delisting their ADSs from the New York Stock Exchange, and the Washington Post explained that the question of who owns Taiwan is a big risk for a clash between US and China, but overall, the author is still optimistic despite these and other risks, but he does understand why many investors are avoiding companies like Alibaba. So Alibaba's fiscal year begins on April 1st, so financial year of 2021 ended in March, and the latest quarter 2 of 2022 was through September, and at the time of his writing, 100 RMB is equivalent to about $15.65, which was used in these numbers up here when he was doing his calculations. So this is the bull case for Alibaba by Eric Sprague. So looking at the earnings calls of the years, it's clear that China's consumption and digitization are set to continue. In the quarter 3 2016 call, Alibaba CEO Yong Daniel Zhang said that they are seeing an increased consumption from an expanding middle class, especially in urban areas. The ability for Alibaba to thrive with the ongoing shift to digital is spelled out by Executive Vice Chairman Chung Tsai in the quarter 4 2017 call. Alibaba is best positioned to capitalize on this digital transformation for three main reasons. One, we have the consumer scale of more than 500 million mobile active users engaged in commerce activity monthly. Because of this, we are the partner of choice for operators with a physical retail footprint. Two, they have a continuous fresh data engine generated by these users across their ecosystem of internet services, from shopping to local services to entertainment. And the third is that they have technology. Their cloud computing technology gives them the proprietary capability to manage massive amounts of data, and our development in the AI artificial intelligence gives us the brains to get value out of that data. A similar idea was reiterated in the quarter 3 2019 call, with the same executive vice chairman talking about e-commerce consumption and the digitization increasing faster than the overall economy. The reality is that the absolute dollar amount of wealth creation in China, in the Chinese economy, will be well over uh, 800 billion USD each year. We have the conviction that e-commerce and digitization of retail will continue to grow at a faster rate than the overall economy. While the overall economy grew in single digits, the e-commerce sector gross merchandise value grew between 20 and 30% over the last several years, and that is because technology innovation and improved productivity are driving sustained growth over a longer period of time. Per the quarter 4 2019 call, the middle class population in China is over 300 million, which is almost the same size as the entirety of the US population. Also, the middle class is expected to double over the next 10 years, and consumption from smaller cities is expected to triple to 7 trillion within 10 years as well. Pinduoduo, which is listed as PDD on Nasdaq, can do well with the metaverse, and JD has an edge with quality merchandise and integrated logistics, but Alibaba is the everyday company for regular purchases. They continue to benefit as more parts of the day-to-day economy move online, and the quarter 4 2019 call makes it clear that as the gross merchandise value leader, Alibaba is synonymous with everyday consumption consumption in China, and that Alibaba can help all the parts of the value chain as China continues to be moving online. And this is a pretty strong case given that Alibaba has a massive force in the Chinese economy. As we read earlier, they have close to 935 million um, active users within China itself. So we believe there are two engines to drive Alibaba's long-term sustainable growth. First is the consumption. China's evolving economic structure and leading development are being accompanied by strong consumption demand. As the largest e-commerce platform, Alibaba is becoming synonymous with everyday consumption in China. They are very well positioned to continually and continuously grow customers' mindshare and wallet share in the various areas of their lives, from physical goods, local consumer services, and digital content. Second is the digital transformation of all businesses. As China marches into the digital era, Chinese enterprises will need core technology innovation, integrated data processing capability, and the digitization of their businesses in the entire value chain. In the past 20 years, that they've built a broad range of platform services, including retail, marketing, financial services, logistics, and cloud computing services, all of which are enabled by our advanced data technology from the core of Alibaba Business Operating System. And this system will allow their enterprise customers to achieve digital transformation and allow them to become a leading partner for enterprises in China and all around the world. And he basically continues to explain how in the next 10 years, digitization of the economy will be further accelerated by the advent of 5G connection and the proliferation of Internet of Things devices. This will have far-reaching implications for all industries and processes, including public services, manufacturing, supply chain, distribution, product development, and marketing. I won't go through this entire article because it is quite long, but the basic case is Alibaba has a massive share in the Chinese economy, which is correct. China is one of the fastest growing economies around the world, although it is slowing down. It does hold a massive share, a massive power on the global stage, and accompanying with their extremely fastly growing middle class, plus a middle class that likes to spend, and Alibaba having a huge power over that middle class's spending. You can see how Alibaba, as China grows on the world stage, you can see Alibaba growing with it, and that is basically the bull case from Alibaba. The next thing we'll be looking at is the bear case for Alibaba. So this basically talks about DiDi Global having its delisting on the US exchanges and how Alibaba has a risk for that to happen as well. They're talking about the stock price plummeting, and the increased ADR risk is not only the risk for Alibaba, and it does not bode well for the stock's future. So this is basically talking about how DiDi Global, a vehicle hire company, sparked outrage in the CCP with its IPO on an American stock exchange months ago, is planning to delist its ADR shares. Basically, it talks about how the CCP's pressure was effective against the company, and a similar thing could happen to Alibaba as well. And that poses a risk to investors, obviously. So that is one bear case for Alibaba as well. And another thing that a bear case that they've made is that slowing retail sales growth in China may have an impact on Alibaba's e-commerce sales in the future. So when Alibaba reported third quarter sales in November, it was unable to maintain its revenue guidance for the current year due to a slowdown in China's retail spending. As previously stated, Alibaba forecasted a 29.5% revenue growth for 2022 in May of this year, and last month's third quarter earnings reports reduced this guidance to a range of 20 to 23%. The issue for Alibaba is that China's growth is slowing faster than expected, which does not bode well for e-commerce sales. If the Chinese consumer spending does not recover quickly, Alibaba's sales may increase by less than 20% next year. And retail is not the only issue confronting the Chinese economy. China's GDP grew at just 4.9% between July and September, which is the slowest rate in more than a year. Real estate issues are largely to blame for China's slowing economic growth, and they are affecting e-commerce firms. China's retail sales growth has slowed dramatically this year, with sales only increasing by 4.9% in October, and this was the Chinese economy's third lowest growth rate in 2021, posing a significant challenge for companies like Alibaba that rely on online spending to drive sales growth. Over the last decade, China has seen a massive debt-fueled real estate boom, but it appears that Chinese economy will pay a price for it, and then it talks about the Evergrande crisis that happened a few months ago. So what will happen with Alibaba next? Although Alibaba is not in an existential crisis, the situation appears dire from my perspective. It's being the author's perspective. A regulatory crackdown with an increasingly hostile regulator, the possibility of punitive fines, real estate issues that risk spiraling out of control and weighing down economic growth, and slowing retail sales growth are all problems in addition to the most obvious risk, the delisting of Alibaba's ADR shares. Based on the information we have at the moment, I would estimate the risk of delisting to be about 80%. Once again, this is the author. I would expect it to be much, much lower than 80%. I think that is a gross over um, estimation of the risk of Alibaba being delisted, and I don't believe it is that high. How the risk is still there. In the event that Alibaba is delisted from the US exchanges, investors will most likely be able to exchange their ADR shares for shares listed on the Hong Kong Stock Exchange, and Alibaba's ADR shares listed on the United States may still be subject to increased selling pressure, potentially resulting in even larger losses for Alibaba's investors. These losses could be in addition to the billions of dollars inflicted on shareholders over the last year, and I won't read the rest of it. This is basically talking about the ADR share risk, which, although it exists, I do believe that this is kind of grossly overestimating the risk that it poses on shareholders. One thing I do think that this is making a very strong case of is China slowing off its economic growth. Alibaba relies heavily on the Chinese middle class, as you can see, close to a billion out of their 1.24 billion users within China. So basically, what that means is any slowing of growth within the Chinese middle class has a massive effect on Alibaba's business. While the other article said that the Chinese middle class is expected to double over the next 10 years. It does seem to be that China's GDP growth and their middle class spending is set to decrease, which could offset those benefits, and once again is a valid risk that Alibaba investors are taking. Now, the crux of this video, and if I remembered at the beginning, I would have mentioned if you wanted to skip to the main part of this video, is this article by Dividend Sensei saying that Alibaba's thesis is close to breaking, 5 things that investors need to know. The summary of this is that Chinese tech stocks have gotten crushed. Baba is down 54% from its highs. China's government is potentially preparing a ban on all future foreign tech IPOs, cutting off 46 trillion in growth capital through 2030. It talks about China's new policy towards tech innovation, focused on top-down government-sponsored investment at the expense of tech entrepreneurs. And you can just read the rest if you want. I'll go down to the important part. Is that Alibaba's growth outlook has been cut in half, and this is one thing that investors definitely need to be looking at. At the start of the year, management said it was planning to reinvest all marginal earnings into future growth. In other words, 2021 was to be a growth year, and investors should expect 0% earnings growth. The earnings per share growth in 2020 was 31%. The 2021 growth consensus was negative 16, then 15, then 21, then 16, then 12%. Following Alibaba's disappointing earnings, analysts now expect a negative 16% growth this year. Some analysts have become rather bearish on Baba's growth prospects, which according to Wise Charts have plunged more than 65% in the last few months. And of course, that's just several analysts, and the consensus from all 58 analysts on Wall Street is more important. Before the regulatory crackdown began in November of 2020, Alibaba's median growth consensus forecast from all 58 analysts was 25%, and it's been cut in half and is potentially set to fall even further. Baba's 2025 EPS consensus was initially rising as the regulatory crackdown began, but it steadily declined as Beijing's relentless wave of new regulations and fines has taken its toll, to the tune of 44% decrease in long-term earnings potential. You can have a look at these graphs. Pause the video and have a look at these graphs later on. The next one is Baba's balance sheet consensus forecast. So Baba has more cash than debt, and that cash pile is expected to grow rapidly in the coming years. That's all despite the headwinds it's currently facing. These balance sheet estimates could include 15 billion in social spending Baba plans under the Common Prosperity initiatives that all big Chinese companies are now pursuing, and currently they have a profitability rank of 8 out of 10, which is pretty solid. Baba remains a wide mode company with historical profitability in the top 20% of its peers, and overall, on a balance sheet perspective, it is a pretty solid company. Baba's trailing 12-month profitability versus its peers. In the last year, despite all the headwinds, its profitability has been the top 15% of its industry, which is pretty solid. Looking at their margin consensus forecast, analysts expect profitability to remain stable in the future despite significant more growth spending. Joel Greenblatt, one of the best investors in history, considered the return on capital to be his gold standard proxy for quality and moatiness. Greenblatt's 40% annualized returns over 20 years at Gotham Capital were generated from his approach of combining return on capital and valuation. Returns on capital annualized pre-tax profit, basically this. However, Baba's ROC has been trending lower for the last 15 years and is one thing that investors should definitely be looking at. Look at their growth spending forecast. Alibaba remains confident enough in its future to rapidly increase growth spending from 37 billion last year to over 63 billion by 2023, according to analysts. And Alibaba still remains the cloud computing king of China and one of the largest industry players in the world. So that brings me to the basically just some technical analysis before we finish it off. You can see the stock has taken a massive crash and it is very clearly in a downtrend. It's trading much lower than it's trading much lower than its 250 or 20-day simple moving average. It's currently trading at 125, which was last seen about June of 2017. While it does still have a very big share in the Chinese market, with the Chinese economy slowing down with increasing regulatory concern, there is some massive risks that are in play right now. However, I just want to end it in one thing. People in 2017 were willing to pay $125 for Alibaba's growth, and you can see most of for almost majority of the last few years up until the beginning of 2021, the growth more or less did pay off. Now, fast forward 4 years later, towards the end of 2021, the stock has crashed again. And this time, investors are once again saying the same things that they were saying 4 years ago. Regulatory concern, slowing down Chinese growth, which are all valid claims, but I do feel like it is a much more established company, and it does have the potential to being a game changer in the future. However, I would not invest a huge percentage of your portfolio in this company, as it is a very high risk, high reward company if you are seriously looking at it. So that brings me to the end of this video. If you do find it useful, do consider subscribing. Let me know what you think of Alibaba, and I'll see you in the next video. Bye.